Hello, morning and welcome to another Macro Mondays. My name's James Brodie and today we'll be looking at the recent breakout in the equity markets, the huge surge higher in commodities and especially focusing on the sudden breakout in silver. But first of all, we'll look at last week's data because that's created some big moves in the markets. First of all, US CPI. The market was focused on this and fearing a bigger number. The market was expecting 3.4% and it came bang on. US yields fell immediately and the fear of inflation, stagflation is receding. The flip side though, at the very same time we had retail sales data and this came out much weaker than expected. Expected up 0.4, it came in flat. The consumer in the US is hurting and we've seen from recent employment data unemployment is ticking up and the economy is clearly slowing. US industrial production also expected to gain its estimated 0.3% growth. That also came in flat. Even more data the economy is slowing. The Conference Board's leading economic index fell 0.6. This has now been in contraction since June 2022. And the National Federation of Independent Businesses, small business optimism is back at recessionary levels, 89.7. Here you can see the chart of the Conference Board's leading economic index. Every time that falls below zero, there's been a recession, going back to 89, 2000, 2008, and of course during COVID. In fact, 94 and 97, when we had the bond crash, and 97, 98, we had long-term capital management crisis, we had Russian default, and we also had the Asia crisis. Even then, the index only got to zero. Well, you can see how much contraction it is in at the moment. This is not good for the Fed, and the next move is certainly going to be a cut. It's a case of when and by how much. Credit card delinquencies over 90 days, Equifax data. You can see this is also starting to surge. We know consumers are hurting and particularly low-income consumers are being forced to take second and third jobs. The National Federation of Independent Businesses, business optimism, as you can see here, this is showing great weakness too. Elsewhere in China, we had more mixed data. Industrial growth was strong. Expected 5.5% growth, it came in up 6.7% year on year. The flip side, unfortunately, retail sales was very weak. Expected up 3.8%, came in just 2.3%. In China, home prices fell 0.94 in April, falling 30 of the last 33 months. In China, between 70 and 80% of household wealth is in property, and this continued fall is extremely painful for the consumer. That's why we're seeing retail money pouring into gold and other commodities as well. On Friday, the PBOC came out with a huge stimulus package to help support the housing market. Housing stocks, equities are pushing higher. In fact, the Chinese equity market's on a strong run, but we need to see more strong data out of the economy. Elsewhere, the UK, we had very weak jobs number. Month on month, employment was expected to rise 20,000. It fell 85,000 jobs lost. And the unemployment rose to 4.2%. I'll bring us straight to this week's data because perhaps the biggest data this week is out the UK with CPI data on Wednesday. Don't forget the Bank of England's target is 2%. And we've been up to 11.1% peak. Last month, CPI came in at 3.2. Because of base effects rolling out, CPI is expected to have a huge fall down to 2.1%. There's a chance if it comes in just below expectations, CPI may fall back to Bank of England's target. This would free them up instantly to cut rates much sooner. The market's currently pricing from the Bank of England 56 basis points of cuts this year. Again, weak CPI and continued weakness in the economy We'll see far more aggressive hikes from the cuts, I should say, of course, from the Bank of England, and we'll see the pound falling aggressively as well. Currently, cable against the dollar is trading 127 dead on. Australian unemployment also jumped last week. We saw that data over the month. It jumped from 3.9 to 4.1%. The market was just pricing chances of hikes a couple of weeks ago. Now it's pricing 17 basis points of cuts. Swedish inflation also is now below target. I mention that because inflation in Europe is not a problem. It's coming in at or close to target. Soon it will be below target. There's a chance we may be talking about deflation in the euro area in the second half of the year. And with that, of course, that would mean aggressive cuts from the ECB and the euro trading a lot lower. Flip side of that, of course, it means the dollar index will be going up. Not a great one there for commodities and emerging markets. OAS pricing this year, the Fed just pricing 44 basis points of cuts. The market's starting to nibble at more cuts. Yields are starting to break lower as the data's coming in weaker. The ECB, there's a 98% chance they cut 25 basis points on the 6th of June. That's pretty much dead set. I wouldn't be going against that one. And a total of 78 basis points of cuts this year. Another one I've not spoken about much before, but Canadian OAS is pricing 35 basis points of cuts this year. We have Canadian CPI out tomorrow. Again, lower than expected. We could see the market repricing this quite aggressively. Bank of Japan going the opposite direction. The market's now starting to price a chance of a second hike this year. 27 basis points of hikes by year end. Moving on to commodities, or specifically China. I've been talking recently about China moving its reserves into gold. Well, some data's come out recently highlighting just how much selling China has done of treasuries and US agency bonds, rising to a record amount of selling. They're diversifying their reserves out of US bonds and into gold and other commodities. In fact, if we look at commodities, copper and gold are at all-time highs, and silver has broken out of a key level. Highlighted recently, 30 was a key level. It's been a quadruple top. It's touched there 4 times in the last 3 years, has been unable to break higher. We said on this show when it broke above 30, you'd see aggressive buying. Well, it did that on Friday, and this morning it was trading at one point up to 32.5. In fact, this morning, both copper and silver in Shanghai will limit up. What else was up? Nickel was up, tin's up aggressively, zinc's up aggressively, aluminium's up aggressively. Do you get the message? Even orange juice is trading at all-time highs. We'll have a look later, an interesting chart showing the ratio of commodities, which is turning higher against the Nasdaq tech stocks, where we're starting to see some of the top funds in the world reducing their positions. So here we have the chart of silver. It broke out aggressively above the 30 level. That's now the key support. We're going to see money moving aggressively into this. And while other commodities such as gold and copper are making all-time highs, silver has a long way to go. Its previous high back in 2011 was at 49.8. I expect to see an aggressive move higher here. We'll see it getting more attention in the press. Retail traders will come in, and we should see a strong trend higher. What I've been looking at recently, a few interesting charts. Here, the correlation of Brent oil with the US 2-year yield. What's interesting here, you can see quite a strong correlation. Of course, so many things move the oil price. Supply and demand, of course, geopolitical tensions, of which there have been a lot recently, OPEC, shale production, and of course, one key driver is the US economy. Over 25% of the global economy, When the US is strong, there's high demand for energy. When the US is weak, then of course that demand falls. What's particularly interesting is October to December last year, when speculators were particularly long of oil because of the events, the sad events between Israel and Hamas and Middle East. Well, geopolitical tensions were rising. Actually, the oil price was falling as the market was starting to price in 6 cuts by the Fed. So you can see a strong correlation there. And as we're starting to see the US economy slowing, I'm keen to see if this correlation continues. The key support in Brent is quite a long way off. It's at $71. But as we discussed on our World of Oil Derivatives podcast last week, the commitment of traders data shows us that the CTAs have now squared up their long position, but speculators are still long. Well, the key stop level for them would be a close below the multiple support lines at $71. Again, horizontal trend lines are incredibly strong. We've discussed the level in gold at 2080. We discussed that in January and February. It finally surged higher. We discussed the horizontal resistance in silver at 30 that broke higher last year. And you can see a key level here. It might trend higher in this cycle, but at some point when Brent closes below 71, you will see aggressive moves lower with the stops being triggered. Dollar yen, currencies have been pretty quiet last week, but I thought I'd highlight again the key correlation, interest rates to currencies. Here, dollar yen and the 2-year yield differentials between the sovereign bonds, the US and Japan, again, look slightly out of line. Any weaker data out the US, then expect dollar yen to have a fairly fast move lower as stops get triggered. The market is very long dollar yen. Record shorts in yen recently. So keep an eye on this. I think we've seen the high in dollar yen for this cycle. On to equities. Recent fund manager surveys from Bank of America shows that global fund managers are the most bullish they've been on equities since November 2021. In fact, cash levels are at 3-year lows, with stock allocation the highest since January 2022. If I bring up the S&P chart, you can see it broke out last week from the key resistance level. This is a great trading opportunity to go long because you can keep a stop loss just below the support of 5,256. If we look back at history, famous traders, turtle trading strategy, a great trading strategy is buying breakouts of all-time highs. And as you can see, the NASDAQ composite and the S&P broken out, you've seen new money come in and stops have moved higher. What's interesting though, on Friday, the VIX fell to its lowest close since 2019. And we have Nvidia earnings coming out on Wednesday. Nvidia's beaten expectations for the last 18 quarters. Will volatility pick up? We'll see. But an important point to remember, while the market's happy to buy equities thinking that the next move by the Fed will be a cut, here's an amazing statistic that gets overlooked. The S&P, the low of the S&P typically comes, if we look at recessions all the way back to 1970, it comes on average 195 days after the first Fed cut. So when the Fed start cutting rates, that's typically because the economy is in or heading clearly towards recession, which is when equities go down. So careful on your timing, your longs here. When equities start going down, the Fed start cutting, the yield curve steepens, and equities go down. Typically at least for about 6 months. The big move of the week was copper. We saw some arbitrage opportunities between the London Metals Exchange and CME, driving the price higher. Of course, the physical traders can take advantage of that arbitrage. But for the rest of us, well, we can still trade. There's the futures, there's contract for difference. even ETFs. And you can see copper has surged higher, and as I say, this morning in Shanghai, it's already been limit up at all-time highs. Chart of the week. This week I looked at a ratio. We've discussed it on our podcast before. It's the Bloomberg Commodity Index divided by the Nasdaq Composite Index. Yes, the Nasdaq's breaking new highs, but we are seeing some of the top funds in the world taking profit. In fact, fund outflows for the first time in over a year, last 2 weeks, back-to-back weeks, there have been fund outflows in tech. Nasdaq, in my view, is expensive, and commodities are surging higher. In my view, we've seen a bottom in this ratio. We had an aggressive move higher, a pullback, and now it looks like the commodities are on the surge higher again. I think over the next few weeks and months, we're going to be seeing more and more discussion about commodities as prices continue higher. It's not just central banks diversifying their reserves, we're seeing aggressive retail buying. And so looking at the week ahead, what data have we got coming up this week? On Tuesday, we've got Canadian CPI. Will the market start pricing more aggressive cuts there? On Wednesday, UK CPI. Again, that's probably the key data this week. We don't have any huge data out the US. Will UK CPI fall more than 1% and come in 2.1%, even possibly at the Bank of England's target 2%. That will be huge news. Wednesday, we also have Nvidia earnings out of the US, US existing home sales and the Fed minutes. Thursday, we have Eurozone and UK PMIs, US new home sales, and on Friday, US durable goods orders and UK retail sales. Again, the data out of the US this week isn't huge, probably bigger data out of the UK and Europe. We have equities trading at all-time highs. We have some commodities trading at all-time highs and the commodity complex moving higher. But we have volatility in equities at multi-year lows. Good luck this week. Have a great week.